My guess would be inflation. The other way I've been putting it is I think recession or no recession is now more sector specific. When you have this big of a gap between fiscal and monetary, you can get sharply divergent sector performance. So, for example, commercial real estate's in a depression, whereas other areas are in an expansion, right? And so I think that we could see a rotation. For example, we are starting to see some weakness in the labor market. You're up from 3.4% unemployment to 3.8. Around the margins, some of that's getting weaker, perhaps, even as we see reacceleration in some of the harder stuff like manufacturing PMIs. So I would have not super high conviction on that because I think even if we do get a recession, it looks different when you're pre-stimulating by $1.6 trillion in deficits. I think you enter a type of recession that looks like a fiscally dominant recession. So my view is even somewhat divorced from the business cycle, even though every 2 weeks I'm kind of trying to aggressively map out, whether the economy is expanding or contracting. But I think that overall, there's when people ask about recession, they often think it's going to look like global financial crisis. It's going to look like COVID. It's going to be this big disinflationary
Mm.
recession. Whereas my expectation is it looks more like a 2001 recession, or it looks more like a 1970s recession. There's different magnitudes it can look like, but I think it looks more like those other types of recessions, even if you were to get one. But yeah, my answer would probably be I would expect higher inflation before recession, but not super high conviction.
In a recent discussion, Lyn Alden provides insights on potential shifts in portfolio strategies amidst changing economic dynamics. With unemployment inching up from 3.4% to 3.8% and signs of weakness emerging in certain sectors, Alden suggests a nuanced view of recession risks. Despite concerns, she highlights the influence of fiscal dominance, anticipating a recession that diverges from traditional models. Expectations lean towards higher inflation preceding a recession, although with no super high conviction.
One thing I would add to that, if investor's goal is to offset an equity portfolio, so whether you're an institution or a retail investor, obviously the 60/40 stock bond portfolio, the bonds are there mainly to smooth out volatility in the equity market, and that works fairly well in monetary dominance. But when you're in fiscal dominance, generally other asset classes tend to be better at offsetting the equity. So, for example, one like you can kind of imagine two directional risks you're worried about. One is obviously recession. That's where, for example, shorter duration treasuries could be helpful, kind of cash equivalents or up to maybe the 2 year or a little higher than that, kind of short end of the curve, basic protection against just kind of earnings disappointing and all these things like that. On the other hand, if you're worried about inflation reemerging, yields going up, then owning things like energy stocks, for example, or direct oil exposure, or gold or Bitcoin. These are the types of assets that I find more interesting to match with my equities in this environment because the entire 60/40 portfolio is kind of designed around that structural disinflation, structural declining interest rates. And as we go to a new period, I think these other assets offset and kind of smooth out an equity portfolio better than just long duration bonds, which is I think Bloodsport's a good phrasing for it. I kind of just I call it the too hard pile. I put bonds in the too hard pile because if bond yields go up, there's other asset classes that I think would be more affected. And if bond yields go down, as Luke said, I mean, I'd want to own things like gold and Bitcoin. I wouldn't want to own, whatever move I could get in that long duration treasury yield. There's other assets that I'd probably want to own. And it also depends on what reason it was for those moves. And so I've just not been really using long duration bonds as a portfolio segment, even though I am acutely aware of things like recession risk or inflation risk. I find that other assets work better with the equities. My guess would be inflation. The other way I've been putting it is I think recession or no recession is now more sector specific. When you have this big of a gap between fiscal and monetary, you can get sharply divergent sector performance. So, for example, commercial real estate's in a depression, whereas other areas are in an expansion, right? And so I think that we could see a rotation. for example. We are starting to see some weakness in the labor market. You're up from 3.4% unemployment to 3.8. Around the margins, some of that's getting weaker, perhaps, even as we see reacceleration in some of the harder stuff like manufacturing PMIs. So I would have not super high conviction on that because I think even if we do get a recession, it looks different when you're pre-stimulating by $1.6 trillion in deficits. I think you enter a type of recession that looks like a fiscally dominant recession. So my view is even somewhat divorced from the business cycle, even though every 2 weeks I'm kind of trying to aggressively map out, whether the economy is expanding or contracting. But I think that overall, there's when people ask about recession, they often think it's going to look like global financial crisis. It's going to look like COVID. It's going to be this big disinflationary
Mm.
recession. Whereas my expectation is it looks more like a 2001 recession, or it looks more like 1970s recession. There's different magnitudes it can look like, but I think it looks more like those other types of recessions, even if you were to get one. But yeah, my answer would probably be I would expect higher inflation before recession, but not super high conviction.
Continuing her analysis, Lyn Alden delves into the dynamics of asset performance amidst evolving market conditions. Emphasizing a shift towards fiscal dominance, she underscores the significance of fiscal deficits and Treasury market dynamics over Federal Reserve actions. With a bullish outlook on gold and Bitcoin for the next 18 months, Alden anticipates significant upside potential, driven by favorable liquidity conditions and sustained demand. In navigating investment decisions, she highlights the importance of monitoring fiscal policies and structural factors, suggesting a broader perspective beyond short-term interest rate fluctuations.
So we've been in like a consolidating liquidity range for quite a while. My expectation is that over, call it 18 months, we break out of that. Um, Watching this kind of gold consolidation, it kept banging its head around the all-time highs of 2000 and change. My view was I don't know when it's going to break out, but once it breaks out, I think it's going to have legs to it. I think we're in the middle of that move now, and I think it's one of those things you don't want to overthink it. Like it can get near-term overbought, and people are going to be like, it's going to correct, and it absolutely might. But it's been in a bear market since like 2011. It's been in a consolidation for 3 years. I do expect a pretty significant run here. For Bitcoin, most of the indicators that I track point to being fairly mid-cycle in terms of the bull run. And so I still think the next 18 months look favorable for the asset. Again, it tracks global liquidity pretty well. The on-chain indicators can show us, for example, how much long-term holders are selling into the current strength. Because even though obviously Bitcoin supply is constrained, if the price goes up, 3x or 5x in a fairly short period of time, you generally see some of those older coins start to come to market and start meeting that new demand. And we've seen some of that, but so far we've seen less of that in this cycle than in prior cycles. And so I still think my expectation is there's room to run both from the liquidity side being fairly constructive, so that should help demand. And I still think that there has to be a higher price to unlock some of these older coins to meet that demand. And so I would be surprised not to see six-figure Bitcoin over the next 18 months. Obviously, anything's possible, but I'm bullish on both gold and Bitcoin in that time frame. I think the funny thing is that because we're kind of largely in fiscal dominance now, I think that the emphasis on the Fed is in many cases like backward looking, that the Fed has been a bigger source for markets for a long time. But as we kind of enter this fiscal dominant environment, I'm increasingly less interested in what the Fed does around the basis point margin. And more interested in what's happening with the treasury market, more interested in what's happening with the size of fiscal deficits, and those kind of more structural things. So to the extent that the Fed, cuts rates a little bit, or if they even add some interest rate hikes to it, it's not really the answer in my view. I think basically that the large structural fiscal deficits are a bigger factor. And ironically, if they try to get down inflation by increasing interest rates, they're going to blow out the fiscal deficit even more. And so that's the lever that's different from the 70s, but closer to the 40s. Um, and so for me, it's looking at, what are tax receipts going to be like? So for example, now because 2023 assets were pretty good, asset prices, we should expect decent tax receipts here, which ironically could narrow the deficit a little bit, which could give us, kind of a somewhat weaker performance in 2024 for at least some of these, like say mega cap assets. I think those factors matter more. I think also we've seen, for example, some of the treasury decisions to shorten the average duration of their treasuries have had bigger effects on the market than what the Fed does in a given meeting. So some of these quarterly treasury releases have been bigger factors than the Fed. Obviously, during kind of acute liquidity things, like for example, the early 2023 banking issue, that was both a Treasury and Fed issue together. But in general, I think that overall liquidity, overall fiscal is actually a bigger force than the Fed. So I don't really have a firm view. Let's say a -3 cuts or plus a couple hikes. That range is largely irrelevant for my investment decisions. Obviously, if we were to get major moves outside of that range, I would start to care again. But as long as expectations or my expectations are fairly somewhere in the middle, I think that's not the biggest lever to be focused on compared to what's happening in fiscal, compared to what's happening in, say, supply and demand of oil. Um, those I think are the bigger forces.
Today, we've explored Lyn Alden's key insights on portfolio strategies and market dynamics. Alden emphasizes adapting investment approaches to evolving economic landscapes, particularly under fiscal dominance. From bonds' role in offsetting equity portfolios to the impact of fiscal deficits, Alden provides valuable perspectives. We've discussed potential shifts in asset performance, including her bullish outlook on gold and Bitcoin. Share your thoughts below, subscribe, like, and share to spread knowledge.